Welcome to the Teaminvest Wealth Builders podcast, where we bring you insights, strategies, and stories to help you build and compound your wealth and knowledge. I'm Kerry Fleming, your host for this exciting series. Whether you're a seasoned investor or just starting your wealth building journey, this podcast is designed to inspire, educate, and empower you. Let's get started. Joining me today are Tip Group CEO Andrew Coleman and Head of Funds Management and Education Sanji Narendran. In this episode, we're unpacking a topic that sits at the heart of long-term business success: the difference between a partner mentality and an owner or founder mentality. You'll hear a thoughtful discussion about why the mindset of a company's leadership, whether they see shareholders as true partners or simply as investors, can make all the difference to a business's growth, resilience, and culture. We'll explore what it really means for management to act as partners, how this approach contrasts with the classic founder-driven style, and why finding the right balance is crucial for sustainable value creation. Drawing on well-known case studies and real-world examples, we'll also look at the risks and rewards of both mentalities and offer practical insights for investors who want to spot the businesses most likely to thrive over the long term. Let's dive in.
There are a lot of terms that get thrown around in investing about the different ways in which we want to see boards and boards and executives interact with shareholders. And at Teaminvest, we use a very distinct term called partners mentality, as opposed to others in the market of saying looking to invest in a founder or an entrepreneur or a business who has got strong governance or that deals with the shareholders in an appropriate nodded way. So Sanji, maybe my first question for you today is, what is a partner's mentality, or at least to Teaminvest?
Well, I think when we look at a partner's mentality, what we want to see is a group of, whether it be a board or management, that interact with their shareholders as partners. We're all along for the ride together. They're the ones actioning things, putting it into work, and we're the support. We provide the financial support for the business to continue. Now, we need to work as a team and see each other as a team, not that they see us as a check writer or a bank or a lender, and really they're doing their own thing.
Yeah, it's an interesting point, isn't it? Because I think we forget about that sometimes in the glory and halo effect that revolves around listed companies. But at the end of the day, shareholders are actually the owners of this business. The board and management work for shareholders. Yeah. And yet so often we see boards and management who treat themselves as if they are the celebrity, the important one, and shareholders are an annoyance who come along once a year at an AGM to ask frustrating questions as if it isn't their business that they're asking questions about. We made a bit of a distinction there, or Sanj, you made a bit of a distinction about seeing boards and executives that see shareholders as their partners, not just as providers of capital or a nuisance. Obviously, that disagrees a little bit with another piece we talk about a lot in Teaminvest, which is that we're looking for businesses with an entrepreneurial spirit, because so often entrepreneurs do tend to see rules, regulations, and shareholders as an impediment to their ability to revolutionize. Could you just go into a little bit of detail as to what is an entrepreneur and why is it that both entrepreneurial flair is important, but it also can't be seen without looking as well as to whether they treat us like a partner?
Yeah, because I think in my mind, at least, there's two very clear distinctions. An entrepreneur is someone that's coming out with an idea or a concept, or looks at something and says, I can do this better, or I can achieve something, or I can deliver this to the market. And they've gone ahead to pursue their dreams. They come out requiring resources, which requires investments and capital and so on. But quite often, entrepreneurs don't end up successful. Statistically, most of the time they don't. But the ones that do can actually take a business, grow that into quite a large business. But it's at times they end up hitting the end of the road, which is generally around the time they decide to list. That's in my experience anyway.
Yeah, and it's an interesting distinction, isn't it, right? Because I think we forget that all companies start with an entrepreneur. By definition,
yeah.
Someone had to see something that they wanted to do, even if it was copying a competitor, but they saw an opportunity in a market and they seized it. That's the definition of being an entrepreneur. Over time, obviously, the vast majority of those fail, but a few who remain they become large enough to list on the ASX. And then the founder seems to get all of this amazing credit, and does get credit for having made that journey successfully, which on the one hand is an incredible story, but it doesn't mean they're set up for the future. And I think where we get sometimes caught up as investors is we want our executives and management and boards to show leadership towards the future of the organization. And there's a lot of data that shows that founder-led large companies outperform bureaucratic large companies. But the flip side of the data as well is that the vast majority of entrepreneurial businesses underperform bureaucratic companies because they never get to the point of being anywhere near the same size as something corporatized. And so what's really interesting as a distinction as an investor is trying to, and I know you and I talk about this a lot, trying to identify that particular sweet spot of convergence where you have a large founder-led organization or founder mentality organization that also displays partners mentality, because those ones where the founder has worked towards developing a second and third level of management, where the founder has worked towards corporatizing and bringing shareholders along the journey and treating them like partners, they're the ones that build a culture that can drive the business for 20, 30, 40, 50 years, well beyond their direct personal involvement. Whereas the ones that lead by being the celebrity or being the smartest person in the room, they can make a lot of money for a while. But in the end, they can't transition beyond the executive, or they end up getting caught in risky behavior when things start going not quite so well because the founder's ego can't handle the failure. And I mean, we've got some very high profile examples of Sam Bankman-Fried recently, of course, in the United States, and Elizabeth Holmes, but even, you know, right here on Australian shores of companies that one would have thought, because of their scale and position, would have had founders that had built multiple levels of management and treated shareholders as their partners, and certainly were market darlings, that perhaps as behavior may be resulting in questions, and shareholders have suffered as a result. And of course, I'm thinking there of companies like Magellan with Hamish Douglas, Mineral Resources with Chris Ellison, and Richard White at WiseTech, of course. Obviously, three companies that I know you've covered in a lot of depth over the years. So what do you think separated the change there from being brilliant founder and making shareholders a lot of money into destructive founder? You know, what did you see as the shift?
Look, for me, the observation of the ego. When they become, these companies become listed, they get a lot of publicity. It needs publicity to list a company. Any good broker will make sure that there's a fantastic story with a lot of publicity, because that's what's going to get the people investing into the company. So you find a good broker, you get a good publicist, you get a great marketing team, and that business turns that founder into an idol. And once you get there and you start believing your own hype, that's, to me, you start to see the downfall in them. When their mentality starts to switch, and then they're invited places to be a guest speaker and paid quite handsomely to just rock up somewhere for half an hour or an hour to say a few words, and they're treated like a celebrity, they get into that celebrity mindset. It's all fancy dinners, fancy cars, it's all about the show. And then the focus on the business is really gone. One of the things I've noticed, and I don't know about you, but people that have started businesses with a few founders have, in my opinion, had a better chance of breaking through that gap than sole founders, or that was largely based around one person. Maybe ARB was one of the good ones there. PME, we've talked about. But I think there's a few around where there's a group of people that have come together, and they started that partnership mentality already from the beginning.
Yeah, well, Warren Buffett and Charlie Munger, of course, at Berkshire Hathaway. You know, it's an interesting example there. I think it does two things. Number one, I think it's easier to succeed when you have people around you who you trust and rely on. So I think the first gate of can you get to scale is easier when there's a group of you as founders than as an individual, right? I mean, I think that's pretty self-explanatory. But, you know, you mentioned a couple of words there and reminded me there are two great terms that we often use, one in Greek tragedy, one in psychology. The first is hubris, this idea of someone that you really like, who does a lot of good, and by virtue of doing so much good, rises to a level of success, and then that success plants the seeds of their own downfall.
Yeah.
That's the hubris element. And I think it's an underrated element in founder-led success stories because, and I think you hit the nail on the head, right? A founder tends to enter into an industry or an entrepreneur on the basis that they want to work harder and prove that something they believe in is right.
Yeah.
And they're an expert, a deep expert, often in one area. And by virtue of their success, they reach a point where they reach the pinnacle of what they can do in their own field. And that happens to coincide often with at exactly the point in time where they've got a very large amount of money, which they previously didn't have. You know, they were previously bootstrapping their organization. Now they're very wealthy. And secondly, they're getting trotted out to opine on all sorts of things beyond their circle of competence, right? You know, it's almost like this idea that, I mean, look at Elon Musk, right? The fact that you've been a brilliant entrepreneur in one area suddenly makes you an expert about everything.
Yeah.
And that's not true. You know, we know that you aren't. The deep expert in one field is almost always less than average compared to experts in every other field.
Yep.
And then I think that from that hubris point, it sets the seeds of its own destruction. Firstly, the business loses its focus. Look at Andrew Forrest at Fortescue. Loses its focus beyond its core competency and starts to try and grow into all sorts of other areas where it doesn't have the same expertise or the founder doesn't. But secondly, it happens just at the time where there's a lot of money, so you can take a lot of risk, and the founder is most likely to be blinded to their own failings because they've just been told by the AFR or Fortune magazine or, you know, CNN that they are the greatest thing to have happened to capitalism since Adam Smith invented it in the 18th century, right? It's exactly the wrong mix of ingredients to create an explosion rather than, you know, continued success. And I think the second thing that you touched on, which is really, really valuable beyond the hubris element, and is this idea of halo effect, which we sort of touched on there, which is this idea in psychology that we perceive someone who's an expert or has deep knowledge in one area as being an expert with deep knowledge in lots of areas. And so what they're really, effectively what that means is, you know, if you meet a doctor, for example, who's a really top specialist in cancer treatment, right?
Yeah.
We tend to take their views on other things as more weighty than perhaps the evidence says. So, you know, we asked the doctor, you're sitting around a barbecue, Sanjay, you've got this incredible skill set. You've been a great success in cancer treatment. You know, what do you think about US politics? And we listen to their opinion because they're a smart person. Now, of course, statistically, if you take a step back, what likely evidence do we have that someone who is an expert in cancer treatment knows anything about US politics? Or vice versa, you know, Sanjay, you were the Minister of so-and-so in Defence for Australia. What do you think the share market's going to do about tech tomorrow? Well, how are the two linked? But we do this as humans, right? We see great success stories, people with a great halo around them as being experts across lots of things. And I think that occurs in boardrooms far more than we think, right? So I use that founder we're talking about. You've been the founder of the great success. And then the board says, well, we're thinking of going into a new market. You've never been in the market before, right? And they turn to you and they say, Sanjay, you built this business from scratch in this vertical. We're now looking at a completely different vertical and a completely different market. What do you think?
I can do anything.
Exactly.
Right.
And I think that's where, as a shareholder, you take huge risk, right? You know, the business will morph and take on risk that it doesn't understand just at the time when it has the most money to blow up.
And if you think about it, the founder has to naturally be a risk-taking person. It has to be part of your DNA to take that risk because
wouldn't have fell out business otherwise, right?
And generally you'd see a founder that has maybe 2 or 3 failed businesses before they hit their strides and they've learned their lessons and they've created this big business. But then that doesn't necessarily mean that you can translate one type of business to a different industry or different side of business, different customer group. There's all sorts of nuances with slight variations, let alone major ones. And we've seen, that doesn't mean that a business can hit scale and then have to stop expanding. We've seen great partner-led businesses or founder-led businesses that have continued to expand into diverse different asset classes or different markets because they really understood their core dynamics of what they were good at and how it translated into other markets. But they've also done it in very systematic ways where they've taken a low risk and put their foot in the door. Maybe there's a few
Well,
probably good examples of.
Well, I was going to say there's four that immediately come to mind when you think of that story from an Australian context. I mean, the first is Macquarie Group, Macquarie Bank. I mean, that was a founder-led company that successfully transitioned to multiple different layers of management whilst maintaining the same culture and has become a global success story in so many ways. CSL,
Yes,
same thing. Cochlear, same thing. And if you want to use a US example, Microsoft. Same thing.
Yeah.
You know, Bill Gates stepped away from that business now 20 odd years ago, and yet the business has gone through multiple different layers of management since and continued to not only cement its position, but grow. And I think that's the difference, isn't it, right? That we're sort of trying to hit the nail on in our discussion here, and we talk about in Teaminvest. None of those businesses exist without a strong founder. That was critical. But in order for them to keep growing, year after year after year for decades at a time, not just 4, 5, 10 years. There needs to be at some point where that founder is able to successfully grow the organization beyond their direct control. They don't necessarily step away yet. That's a challenge maybe when age steps in, but they have to be able to build the second or third or fourth layer of management and start to bring in a more consensus-based decision-making because the organization is going to reach a scale that it's impossible to manage well as one person across as many different things as it's going to do. And I think it's really telling if you look at just those two big examples. Let's take Microsoft and WiseTech, just because they're obviously both technology companies, but have had a very different philosophy on that. You know, Bill Gates appears to have from the beginning had a clear strategy, anyone who's read up on Bill Gates, that what he wanted to do was hire great talent in different areas, empower them and let them step up to eventually reach the point where he could step away. And I think the most amazing thing about Microsoft from that example, in my mind, is how that partner mentality of what Bill Gates built around that partnership with the developers and everything else has run through multiple layers of management. And if you contrast that with Richard White, who's just come out and said, I am WiseTech. No plan for succession, get rid of the board that disagrees with him. Or even what's happened at Apple. In the transition between Steve Jobs to Tim Cook, and now Tim Cook effectively having not innovated for over a decade from what was such an innovative company, you can see the difference in that culture passing through, depending not on those cases of whether they had a brilliant founder. All three are brilliant founders, but how that founder viewed their relationship to the others in their business and their shareholders as partners versus it's my business, I'll do it my way, and when I'm not here, that's your problem, not mine.
And it's quite often really hard to see when we are just investors or shareholders on a market. So when you see founders, you can try and pick that up, but usually it's very hidden. But the real tell for me anyway is when you speak to their next level of management, when you speak to the CFO or the COO or the head of in different divisions, and then you get an understanding of the relationship between those people, and you realize if the founder is calling the shots and these guys are there to deliver on what the founder has said, or if they're given the freedom to go out and run the race and do exactly what they need to do, but at the same time, they're held responsible and accountable to that founder for anything that they do.
And I think, isn't this an interesting one? Because I don't think many people would think of Charlie Munger and Warren Buffett as brilliant business people. They think of them as brilliant investors, no question, but brilliant business people. And yet, when you look at it, the probably greatest American success story of successfully empowering other executives to run organizations of material scale across a very large number of industries is, of course, Berkshire Hathaway. Here is Berkshire Hathaway employing hundreds of thousands of people across multiple industries, on the basis that both Charlie and Warren took the view very early on that they could not be an expert in everything. They didn't want to be an expert in everything. What they wanted to do was find great experts and empower them with a combination of support and capital to be the best they could be in their own field, while still seeing them and their shareholders as partners. Which, of course, you know, we've picked an easy lay down misère there, right? I mean, it's a great success story. But there are others in Australia that have done. I mean, Soul Patts is an Australian example of doing the same thing. A smaller scale, very large company, but not the size of Berkshire Hathaway. But similarly, investing in and empowering other executives rather than the Milner family trying to stand there and say, we know everything about everything because we're a billionaire. And therefore, we can tell you how to run your coal mine, how to run your swim school, how to handle private credit. They haven't. They've taken the opposite approach. And I think what's really interesting from an investment point of view is founder-led companies tend to outperform the broader market as an average. And that's because they have that dynamism. And we've identified that. You want that there.
They're quick and they can move.
Absolutely. But they are also materially overrepresented in capital killers.
Yeah.
So your average of that bucket of founders will do better than the market because of the dynamism. But within that average, you're going to have some companies that do shoot the lights out, that do innovate, that do manage as partners, that do build a second layer of management, that handle their shareholders appropriately, that engage with stakeholders. And you're also going to have others that blow up all your money or most of your money. So the average works.
Yeah.
The problem is if your bucket invested in didn't encompass all of that, your return is not the average.
Yeah.
Your return is the assets you owned. So for example,
whether you've picked the higher end of that average or the lower end of that average.
Exactly. So take the Australian comments. If you had owned Macquarie Bank 30 years ago, or owned ARB 20 years ago, or still today potentially, or CSL or Cochlear, you're up stupid amounts of money, right? But if you happen to own the ones who fell on the other side of that equation, the Forge Resources, the ABC Learnings, the Kogan's Paps, the Afterpays. The Afterpay was sold for a large amount of money. What are the other ones now? Easy Pay and others, Latitude Financial and others. Your wealth isn't flat or up. Your wealth is materially down. And that's the piece that I think is why it's so important to separate, at least in my view, when I look at it, the difference between founder mentality, which is that drive for entrepreneurial flair and feeling ownership of the business, which you want, from the next level up, which is partners mentality, which is both that combination of entrepreneurial flair and feeling of ownership with a desire to preserve that asset for many generations by building a team and by treating shareholders as partners in a much larger story rather than as just passive investors along the founder's journey. And it's a higher bar, but it's an important bar because it's what separates the top and bottom of those two tails.
And if you think about any business and you think about the journey of a founder that had to, by definition, be there from the start, they can take it to a certain point, but then there's only a certain lifetime for that founder. So any business in that growth period is going to, well, not any business, a lot of founders fail, but the ones that do succeed have got there by getting into that growth period. So yes, it makes sense that there's a high growth when it's a founder run company, but that transition into the next level, if they don't come in with that partnership mentality to back up what was done by the founder and where the founders left off, and then once they start getting to scale, be able to bring that partnership around them, that's when you definitely see a business going and falling flat.
Absolutely. And I think there's two key risks there that you've identified that are so fascinating because they're opposite sides of the same coin, but you need to be aware of them as an investor. The first is the key man risk associated with the founder. It's that idea that only the founder could grow this business and they haven't systemized it or haven't built the culture around them that enables the founder to hand it on to someone else successfully. Yes. And you see that all the time. The vast majority of founder-led successions fail. They hurt the investors afterwards. But the second risk about it is also that idea that the founder caps out. Yeah. That a founder who hasn't built that appropriate path in advance eventually will, in the words of Cyril Northcote Parkinson, rise to the level of their incompetence. I mean, that's such a fascinating study of the 1960s on management science, but that idea that any person given enough time and resources, so in an organization large enough, will inevitably be promoted to the point where they are now incompetent. Yeah. And the reason behind that is really simple, right? If you're competent at your job, you do well. Yeah. The job grows.
That's right.
So you get promoted, whether you get promoted physically, as in it's a promotion in your job, or in the case of the founder, your business grows, until eventually you reach some point, and for each person it's different, where you're no longer capable of growing it further. You're no longer competent, at which point you don't necessarily get sacked because you've got it to this point, but you're now incompetent. You can't take it further. And I think it's those two pieces that we so often miss. And I think what's particularly toxic when you miss that, most people, and you would see this, all of you would have seen this in your personal lives, when they reach that point of their incompetence, the vast majority of people don't have the self-awareness to say, I've gone too far.
Yeah.
Now it's my job.
Denial.
Exactly. And they start to lash out.
Yeah.
They start to take risks that they wouldn't have otherwise taken. They start to damage their relationships because they're depressed and angry. And that's bad enough in a personal circumstance when it's your friend in a job. But when it's managing shareholders' money,
Yeah.
that's when you start, I think, can't prove this, but I think that's when you start to see the behavior where they blow up lots of money on failed acquisitions, or they try and geographically expand into areas they don't.
Trying to recapture their youth.
Or they get involved in all sorts of personal scandals. Or the other one, of course, that we see at times is they lash out at analysts and journalists and others and start to damage the reputation of the company through their personal activity. And it's not because they're bad people. They're not. It's that if imagine being that person who successfully ran 10 staff, then 100 staff, then 1,000 staff, and now you're running 10,000 staff and it's too hard and it's too stressful. It's no surprise that you see that bleed into decision-making and actions in ways that are, in the end, counterproductive. Because how hard is it to identify?
Yeah, and I mean, I know even if it was me and if I was in a position where I'd taken it up to 100 or 100,000 staff, and you go, I got it here, you know, why are you telling me I can't go any further, right? I've taken it this far. That means I'm doing something right. But realizing for yourself that, okay, I've got it to this far, I need somebody else that's going to be better able to take it out to the next level. Because everybody has their limitations on their core competence.
Absolutely.
You can keep growing it, and a lot of things you learn along the way, but it's, you don't necessarily have an experience.
I think you made such a lovely comment there. You can keep growing it, but the thing can grow faster than you.
Yeah.
I think that's a great example. I mean, if you are a successful founder, and I think potentially I fall into that category and you do as well in your personal lives, by definition, the business you'll be running today is the largest business you've ever run.
Should be.
Yeah, because if you had been a founder of something more successful in the past, the odds are you didn't leave it. You're still there, right? So you are almost certainly going to be in a founder-led business with an executive, a chief executive officer, who's also often the major shareholder, who is by definition confronting these kind of issues for the very first time.
Yeah.
Now, they may be brilliant at navigating those issues. That's why they got there, and I hope they are. But that is absolutely an element of risk, particularly if they don't recognize that and surround themselves with people who've been there and done it before at the level above them. And so often we see with founders, who do they surround themselves? Either with people who backed them early in the journey, the ones I have great loyalty to because you helped me when I was small, but they're probably not the skill set that you need now.
I mean, you're all in the same boat.
Yeah. Or people who look to the founder and say, the genius, this amazing person, the second coming, he can do no wrong.
Yeah.
And of course, at that point, decision-making is unlikely to be as rigorous and detailed as it needs to be. Now, I'm conscious of time for the investors and people listening to this podcast. So what are the key takeaways? I think if I can sum up and then jump in. I think firstly, you want to look for an entrepreneurial company in its nature. We agree. Secondly, founders, on average, once they get to the point of being listed, do well. But that is not a precondition. They are as statistically likely to blow your capital up as they are to grow it from here. So you need to look for companies that go one step further and display a partner's mentality. And the way you can tell that, we think, is watching not only the decisions they make, that's the entrepreneurial outcome, but how they engage with shareholders, how they engage with their stakeholders, so customers, suppliers, and who they put on their board and how they remunerate their staff. Because a board that is challenging the founder, but in a positive way, is likely to set good remuneration targets and be filled with people who have that experience or greater, who can challenge them. One who perhaps may be caught up in hubris or halo effect is likely to be independent non-executive directors with limited skin in the game and no real knowledge of the area, effectively sugarcoating the decisions the founder has made. And those are the ones that potentially are capital killers.
And I also like to look at that management, the whole team, not just the CEO, because it's a team organization. So who do they have alongside them and how much freedom that they give the senior management team to make decisions, take responsibility, and run with something.
Absolutely. I think that's such a critical one. You can't grow an organization beyond a certain point unless you empower others, both with authority and make them accountable for those actions positively and negatively. If it's always my decision or
Yeah.
I did, then at some point that's a risk that as a shareholder you probably don't want to be taking.
Yeah, I agree.
Thank you.
Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.